tuning in. So we did get the interim peace deal announced, of course, over the weekend, and markets, as expected, did gap up. I mean, that would be thought to be certainly a bullish thing for most risk assets. We talked about the fact that when crude oil finally starts to roll over very sharply, and there was some evidence of that, of course, over the last couple of weeks, along with rates and the dollar, that probably would be something that would signal a coming deal. Thankfully, that did happen in principle. Of course, we need to hammer out negotiations, and, it is right to be skeptical that happens right away. But the market, certainly being forward-thinking, has taken the lead at rallying. Many sectors snapping back in very good fashion. And of course, the cross-asset trade of really crude and rates and the dollar certainly being very constructive and all turning down very sharply. The bottom line is this. Look, I think that in general, many of the sectors like semiconductors, which had gotten very overbought, are still overbought. These are still sectors which likely cannot continue to move at the kind of pace that they did in recent weeks and or months. But for the time being, temporarily the snapback is a positive to things like SOXX, for example. This is back now at new all-time highs. We largely held where we needed to. There was some, of course, rolling over in momentum. It's still very low compared to what it was even back on June the 3rd and also in April. So there is some divergence that's certainly starting in groups like semis on a daily basis. But I would just say, until we see now proper evidence of this really starting to roll over, breaking down under levels like, say, 553 to 575, that's an initial support zone, that it's going to be right to stick with this. I just don't feel it's as attractive a sector for those that, I guess, only for those that have the shortest time frame and risk tolerance. Outside of that, there was some really good action in parts of industrials. We did see the XLI now break back out to new all-time highs, a very constructive move in industrials. And also in RSPN, the eco-weighted, this is the one that I normally like to use because it certainly takes out a lot of the larger holdings that tend to disguise that.
All right,
the bottom line, though, is that industrials still have some work to do. They're not as strong as the S&P. We still see downward trends being intact for industrials versus the S&P. So a few things need to change, but it is encouraging now that we're seeing financials and industrials join discretionary, of course, healthcare, and showing some upside participation. That's generally a good sign for the market. So even if tech has gotten overbought, for the time being, this announcement did in fact save the market. It sort of happened at exactly the right time that was needed. And, even though I suspected there could be a lot of back and forth, it's right to stay bullish over the next couple months, I think, because of this, and really just use minor pullbacks, which very well could happen into and or right after the Fed meeting this week as a chance to buy. So the open gap today for the S&P, did cause a movement from 74.56 up to a low of 75.16. So we're approaching all-time highs in the S&P. We did, of course, already achieve that in the Dow and the eco-weighted S&P. Ideally, how this would work, gaps typically represent wave 3 type movement. We would likely push up to challenge, if not briefly get above all-time highs. And then after the Fed, we might see some backing and filling to fill the gap. But I think the technicals are pretty healthy on this immediate snapback. I mean, the total duration of this decline was only about 5 or 6 days, depending on when you look at. And so, there were some reasons to think that, yes, this was now the start of tech pulling back. And, now I think this probably is going to be postponed yet again. It's not certainly right to be bearish on tech, but I just don't see the sector as being as attractive, I guess, over the next 3 or 4 months. I would rather consider other sectors. And yes, it is right to obviously put money into things sometimes that are at new all-time high territory with great technical chart patterns, but at the same time, just be cognizant that, many of these groups have gotten very, very overbought. So the key message here is that, the broadening continues. We have, the interim peace deal has served to cause many parts of the market to start to come together to sort of favor that the rally likely could continue We actually see, energy really rolling over very sharply. I think that's also very much a positive for risk assets, and for crude, we see the price of RSPG as a gauge for just the energy sector on an eco-weighted basis, breaking down to really the lowest level we've seen in about 2 months. So very bearish for energy, I think, over the next few months. I think that crude goes to 60, as we discussed, and I think this really was the day that sort of defined the trend turning to negative for the energy sector. So I think it's right to really avoid most within fossil fuel energy. Meanwhile, healthcare, financials, industrials, discretionary, I think look like good bets for the months to come. And really, technology, as I said, you have to be a little bit more selective here, but the sector sort of held where it needed to. So for the time being, the market rally looks to be intact for now. And we'll talk a little bit more about this heading into the Fed and after, and see what kind of pullback we do get. And barring any real weakness, it's going to be right to still trust the bulls in this case, and not grow too defensive based on what we think should happen based on all of the reasons outside of price. So many things are still giving us a few warning signs here, but sentiment for one is certainly still quite subdued, and I think that is very important and a positive here. So that's all for today. Thanks for tuning in, everybody, and have a great night.
Go, Harley, this way. Oh, we got out of here. Come on, get.